Welcome to our webinar this afternoon, Taxation of Passive Foreign Investment Companies, or as we like to affectionately call them, PFICs. Today's webinar is co-sponsored by Wilkin & Guttenplan and the Patel Law Offices. Before we get started with the presentation, as you're probably used to, there are, in order to get CPE credit, there are some polling questions. You have to answer 3 out of the 4 polling questions to get CPE credit, so please remain on the webcast the entire time if CPE is important to you. There is in the GoToWebinar control panel, there's a chat feature. If you have any questions, please be sure to input them there. We will try our best to address as many questions as we can during the webinar, and whatever we cannot address during the webinar, we will get back to you afterwards. So with that, let me introduce this great panel of speakers we have here today. With us is Parag Patel. Parag is a tax attorney based in New Jersey and Florida, who has worked with our firm for over 20 years collaboratively. Parag's practice is broadly focused on, let me just move these slides. There we go. Parag's practice is a broad-based tax practice focusing heavily on international tax issues, especially resolving many of the issues relating to non-compliance that we're going to be speaking about today, such as Form 8621. In addition to international tax, Parag focuses on income tax, estate and gift, and qualified plan issues. Darko Namowski is the partner at Wilkin & Guttenplan, and he's the co-leader of our international practice group. Darko focuses on inbound and outbound taxation, as well as income tax issues relating to closely held businesses and individuals. Franchelli Diaz-Colon is the senior manager at Wilkin & Guttenplan. She focuses primarily on international tax topics for our clients, is our internal technical lead for training, and she does all the hard stuff. And she also heads up our Latin America practice. And my name is Vinay Navani. I'm a shareholder at Wilkin & Guttenplan. I also co-lead the international group, and I work primarily in the pharma and technology, with pharma and technology clients. So if I were doing this webinar on my own, it would be very simple. I would say, what's the definition of a PFIC, and avoid them. But then you wouldn't get the full CPE credit. So I had to enlist some other people to kind of give some more background into this. But seriously, PFICs have been around since 1986. They always seem to catch taxpayers by surprise. What we see the most common in is people who just have foreign mutual funds. And you can have a foreign mutual fund that looks a lot like a US mutual fund, but the taxation and the compliance is very different. Often no real tax avoidance or anything nefarious going on, but just because foreign mutual funds get caught up in this trap of PFICs leads to some really complicated and harsh taxation. So with that overview, I'm going to turn it over to Darko to kind of get us started on PFICs. Darko?
Thank you, Vinay. Hi, everybody. Welcome to this webinar. I am going to give us a introduction to the PFICs, give us a little bit of history, and give us a overview of what a PFIC is. So, and how we get to the next steps. There we go. Before I jump into my presentation, I'm going to go over the agenda real quick. And as I said, I'll talk about the PFIC introduction, which talks about the historical purpose, the definition, and a few assets and income PFIC tests that we need to look into. Shelley will tell us about the taxation of PFICs and the 3 regimes that we generally see under the PFIC in the PFIC realm. Then Shelley and I will talk back and forth and do a presentation of Form 8621 with an example and mark out some proposed regulations that will impact this. Vinay will come back and talk to us about the state tax impact of New Jersey and New York, which are the states that are closely related to our practice. And then Parag will finalize everything with the non-compliance solutions in case somebody missed the filings of these PFICs for prior years. And then we'll wrap it up with some takeaways related to PFICs and planning opportunities. So without further ado, let's dive in. So historically, right, the PFIC regime I look at as the culmination of the Subpart F regime and rules, which As we all know, Subpart F relates to CFCs, but in case when there's no CFC, the IRS and Treasury and Congress really wanted to make sure want to make sure that people are not investing in foreign corporations that they could easily invest their money in a U.S. corporation. What I mean by that is that whenever there was a investment in a foreign corporation back in the day, until there was a repatriation of cash from that foreign corporation, there was no taxation to the U.S. individual or entity. Due to the fact that people took advantage of this and invested a lot of hard-earned cash into a foreign entity, and they were able to avoid U.S. income tax system because they held the money or the passive income, generating assets into a foreign corporation. The Congress and Treasury did not like that, and they said, in addition to the Subpart F rules, we want to enact the PFIC rules. And the PFIC a little bit different than Subpart F because a PFIC does not have to be a CS for these rules to apply. So with that, they effectively created a different system to tax, a punitive system to tax U.S. persons on their foreign earnings. So a PFIC commonly could include a investment fund, which could be a hedge fund or private equity fund, which is organized in a foreign country, or a foreign mutual fund, as Vinay mentioned. And we see foreign mutual funds very often in our practice, which then fall into this in the PFIC regime. So let's look at a quick definition of what a PFIC is. A requirement for an entity to be qualified as a PFIC or passive foreign investment company is that the entity has to be a foreign entity. The second requirement is that the entity is treated as a corporation for U.S. federal income tax purposes. And this could be a de facto or per se corporation, foreign corporation, or it could be by effect of a check the box selection. Nonetheless, if the foreign entity is treated as a corporation for U.S. federal income tax purposes and meets either the income tax test or asset test for U.S. tax purposes, then that entity is considered a PFIC. In a little bit, Shelley will tell you what that means in terms of taxation, but let's finish up the definition.
Hey, Darko, sorry to interrupt you.
Before we head to the next slide, I want to just mention that, yes.
I think there's some bandwidth problems. Why don't you kind of just, we're having some bandwidth problems on your end. Why don't you just repeat your last 25 seconds about the PFIC, summarizing the PFIC definition?
Okay. Just a second. Yep, of course. Can you hear me now?
Yes, you're good. You're good. You're good. Yes.
Okay. So let me go back. So the requirements for a PFIC, for an entity to be treated as a PFIC, is that it has to meet three requirements. One is it to be a foreign entity, the entity to be treated as a U.S. corporation for federal tax purposes, for U.S. federal tax purposes, and it needs to meet either the income test or the asset test. And for a PFIC to be treated as a PFIC, there's no minimum U.S. Ownership requirement, similar, unlike the CFC, where we need to have at least 50.1% of U.S. ownership for it to be qualified as CFC, as a comparison. So let's look at the two tests that a foreign corporation needs to meet in order to be a PFIC. The first one is the income test. And what the income test says is that if 75% or more of the foreign corporation's gross income is passive income, and we meet the other two requirements, then we have a PFIC. And then we ask, what kind of passive income do we consider for this test? Well, we look at dividends, interest and annuities. We look at rents and royalties, but not for active trade or business. We look at gains or losses from sales or exchanges of certain properties. We look at gains over losses from commodities. We look at foreign currency gains over foreign currency losses. We see this a lot in our clients where there may be a CSC although CFC may not be treated as a PFIC, but we see this a lot with a foreign entity that has related party transaction with a U.S. Entity. Notional principal contracts, rate swaps and equity swaps. And then if there's an income from a partnership and the corporation or individual owns less than 20, or the foreign entity owns less than 25% of the partnership, then that income would be treated as passive income. If the foreign corporation that we're testing, the PFIC, the presumed PFIC, owns more than 25% of the partnership, then the look-through rules apply, and those assets or that income will be treated as passive to the extent that it's passive income for the partnership. One exception, I should say, at the bottom that we've noted here is that the passive income does not include in dividends, interest, rents, and royalties from a related person that is properly allocated to passive income that is not properly allocated to passive income such related person. So if we receive interest or dividends from a related person and for that entity or that related person, it does not constitute passive income, then in the testing for the passive income, we will not include that in the passive category. We'll go into the general category or non-passive category for that purpose. Okay.
Hey, Darko, can I interrupt you again?
Over to the asset test. So oh, sure.
Yeah, I think we're still having a little bit of bandwidth.
Yes, sir. Go ahead, Vinay.
Why don't you turn off your video? That might help.
Yeah, let's try that. Is that better?
Yes.
Can you hear me better?
Okay.
I apologize, everybody. We'll get this sorted out. Thank you, Vinay, for catching that. Okay, so let's move on to the PFIC asset test. And I apologize if everybody was having a hard time hearing me while we're talking about the income test. Under the asset test, if a foreign corporation does not meet the income test, for instance, this year there was not sufficient for passive income, we still have to test for the presence of passive assets. And if the presence of passive assets is 50% or more within that entity, then we likely are falling into the category of a PFIC. So I'm going to skip down to the bottom and kind of define what passive assets are, and then we'll come back into the middle to talk about some nuances here. So the passive assets typically include cash, stock and securities, derivatives instruments, which are swaps and options, or when you think about it, any assets that help for the production of passive income, or assets that produce passive income. When you look at it that way, it kind of makes sense. There's final regulations in 2020 that are kind of getting nuanced here, but generally when we're testing for assets, we look at the average asset value, whether it's going to be the adjusted basis of the assets or the fair value of the assets. Different types of entities may require you to do different testing. We don't want to get into too many details for the point across of testing for assets, for passive assets. Okay, so 3 more things we need to talk about here, or 5, I should say. When we're testing for PFICs, whether it's the asset or income test, we got to look at 3 look-through rules. We mentioned one, ownership in a partnership of 25% or more. There's one look-through rule. There's a second look-through rule when we have a foreign corporation that owns a second foreign corporation as a subsidiary, and that subsidiary look-through rules has another 25% requirement in order for those assets to be looked through and not treated as passive. And then we look to the second tier foreign corporation to see what type of assets are there, and we'll take a proportionate share. There's a second 25% rule that is included in the domestic corporation look-through rules, and that's when a foreign corporation owns a corporation, and if we have 25% or more ownership, then we look through that corporation and pick up only the passive assets of that foreign corporation, not the entire investment. The last look-through rule, which we mentioned earlier, was the related person look-through rule, which says that if we have a transaction with a related party, then the income items that may be passive, may look passive, may not be, if the income items are not passive in the hands of the related person. So then the last thing I want to mention is a couple of exceptions. One is the startup exception. That is, whenever we have a startup in a foreign country and they're in the startup mode, no revenues or little revenue, but they have money in the bank that generates interest income, that may be may give us a PFIC taint. There's an exception for that. And then if there's a change of business organization, there's another exception that gets a little bit involved. I'm not gonna dive into it for the sake of brevity and moving things forward and keeping it higher level at this point. And with that, it looks like we are going to our polling question number 1. So Danielle, if you can launch that, that'll be great. Thank you. Vinay?
And the polling question is a U.S. mutual fund which invests solely in foreign equities, is it a PFIC, yes or no? So we will monitor the responses on our end. Please continue to vote because I want to make sure everybody who wants CPE gets it. We've got most people voted so far. We'll give it another 10 seconds or so to vote. And Danielle, why don't we close the polls now? Okay, and interesting. A U.S. mutual fund which invests solely in foreign equities is a PFIC, and the answer is no, because it's a U.S. mutual fund. So the point of this question is that this is an alternative to PFICs to get the same investment coverage if you can find a U.S. mutual fund which covers the jurisdiction that you're looking to invest in. So with that, I think we can go back to the presentation. And Shelley, I think you're taking over at this point?
Yes.
Okay.
Okay, I'll try turning on my camera. Hope I don't have any issues. Okay, here we go. I'll be speaking now on the taxation of the PFICs. If a U.S. person owns an interest in a PFIC, either directly or indirectly, one of the following 3 regimes should apply: the excess distribution regime, the qualified electing fund regime, or the mark-to-market election regime. Please note you can have more than one regime apply at the same time in a taxable year, but hopefully not. So if no election is made, the excess distribution regime should apply. This is the default regime. And what is the nexus distribution? An excess distribution is the excess of distributions in the current year that exceed 125% of the average distributions received in the 3 years prior. However, if the holding period is less than 3 years, then you look at the holding period instead of the 3 years prior. So note that in the first distribution with respect to a PFIC is typically an excess distribution, regardless of the earnings profits of that entity. With respect to subsequent distributions, then the U.S. shareholder must determine if the distribution qualifies as an excess distribution by using this formula. The gains from the sale of PFIC stocks are actually treated as excess distributions as well. So in the year that U.S. person disposes of PFIC stock, assuming no election had been made, the gain, which is calculated as the sale price less the adjusted basis in the stock, is treated as an excess distribution. Please note that, important to note that the transfer of the PFIC stock in a transaction that would otherwise be a tax-free transaction could be subject to these rules. This is under section 1291F. So to the extent that you have a distribution that qualifies as an excess distribution, the excess distribution should be allocated to the entire period of holding the PFIC shares on a per share per day basis. A few points to highlight here in this calculation is that if more than one distribution is made during the year, then the excess distribution is allocated to the distributions made during the year. In addition, one thing I've seen really often for our clients is the holding period does not include the period in which the person was not a US person. So what does this mean? For instance, let's say you have a non-resident alien that owns shares in a PFIC and they've held these shares for 10 years and they move to the United States. He or she moves to the United States and the person becomes a US resident, he or she disposes of that gain. The gain, as I mentioned before, is treated as an excess distribution and must be allocated to the holding period. However, this holding period does not include those 10 years in which he or she was a non-US person. Therefore, the entire gain is taxable under the excess distribution regime. Another point would be that the holding period includes the date of distribution. So therefore, if a distribution is made January 1st, January 2nd, very beginning of the year, at least a small portion of the distribution would be allocated to the current year. The excess distribution allocated to prior years is taxed at the highest marginal rate in effect for each year, and interest is charged on that tax as if the tax was due on those prior years. So for instance, if the person has an excess distribution and $50 of that distribution is allocable to 2020, and we're looking at the 2021 return, for example, the tax is calculated based on the highest rate for 2020 on those $50, and the interest is calculated from April 15, 2021, which was the original due date of the 2020 return, till the date the payment is made. Foreign income taxes are allowed on foreign tax credits, apologies, are allowed on foreign taxes paid with respect to excess distributions. So just keep that in mind. These are also allocated ratably to each holding period day. So even if the withholding tax is all applied and actually paid in 1 year, you would still allocate some of those taxes to the pre-year's taxes. So continuing on to the QEF regime, qualified elective fund regime. This regime is a flow-through concept for U.S. tax purposes, where the U.S. shareholder recognizes annually its pro rata share of ordinary income and long-term capital gains. In this regime, the U.S. shareholder, to the extent it's an individual, can benefit of the long-term capital gains rate, which is 20% on the pro rata share of capital gains from the PFIC. The election should normally be made in the first year to achieve the best results and avoid complexities. This is because, as I mentioned earlier, you can have both the QEF and excess distribution regime apply at the same time, and making the election on the first year takes away the excess distribution regime from ever applying. And so if the QEF election is made on the first year, then you will not have any interest calculations and the allocation of the to the previous years. The election is made on 8621. We'll go over the 8621 in a minute. I'll go over how to make the election in that form. The election is not usually made for foreign mutual funds due to the inability to get financial information on U.S. tax basis. And then, so this is just pointing out that the fact that sometimes the QEF election may be wanted by a U.S. person owning a PFIC, but they might not have the ability to get the information that they need to make such election. However, this election is common for private equity funds who have significant U.S. investors. So the U.S. investors are able to push the funds to get these PFIC statements provided so that they can make the elections. The gains upon the sale of the PFIC stock, to the extent that the QF election has been made, are treated as capital gains on our tax at the lower capital gains rate for individuals. And then finally, foreign taxes paid by the PFIC entity itself, so at the PFIC level, may be creditable, but only for corporate taxpayers who own at least 10% of the PFIC. This is under Section 960. You individuals and other U.S. taxpayers are not able to get that benefit. As I mentioned before, under the QF regime, you must get a statement from the PFIC, a PFIC annual statement, which shows the pro rata share of earnings or capital gains, or alternative information to allow you to calculate these amounts that you must include in income. It must be prepared under U.S. tax rules, and actual distributions from PFIC are not taxed again. So this is very similar to U.S. partnership regime, where you pick up the income on a current basis, but whenever you get distribution from the partnership, it is not taxed again. Moving on to the mark-to-market regime, this is the most common method for foreign mutual funds to the extent that they're publicly traded. So this method also takes away the excess distribution regime we just discussed, and is commonly used to the extent that the PFIC stock is publicly traded, and the QF election is not possible. So you have to kind of measure and weigh your options in determining when to make a QF or mark-to-market election. The PFIC stock must be publicly traded or marketable, which means that it's regularly traded on a qualified U.S. or foreign securities exchange. Regularly traded means that it is traded on at least 15 days during each quarter of the year. An option with respect to this type of PFIC stock is also considered PFIC stock. And moving on to the actual taxation. So when you make the election, what does that mean under the mark-to-market regime? You actually have to pick up the increase in value each year as ordinary income. And the increase in value is the fair market value of the stock less your adjusted basis in that stock. These increases in value, again, is taxed at the ordinary rate, so there is no capital gains, long-term capital gains treatment for these for U.S. individuals taxpayers. Actual distributions from the PFIC stock under the mark-to-market regime are also taxed as ordinary income and not eligible for qualified dividends. When you pick up the increase in the value, you actually get a basis step up for the amount that you've included in income, the mark-to-market income. On the disposition of the gain is also the stock is also treated as ordinary income. So in this situation, everything is ordinary income. Nothing will qualify for the 20% rate if you're an individual investing in a mark-to-market regime fund. The decrease in value. So what happens? You have a decrease in value. You measure your fair market value at the end of the year, and you reduce that by your basis, and actually a negative amount. The loss is generally disallowed or limited to the unreversed inclusions. Unreversed inclusions is the sum of all your inclusions in prior years reduced by any other losses allowed in previous years. To the extent that your loss in the current year, your mark-to-market loss is in excess of unreversed inclusions, then you are allowed to deduct the loss. If not, then the loss is disallowed. Any losses that are allowed reduce your basis similarly. So any income inclusions increase your basis, any losses reduce your basis. And in the year of the sale, if you sell the stock and you have a loss that is in excess of unreversed inclusions, you are allowed to take that as a capital loss. With that, I'll move it over to Vinay so he can do the polling question number 2.
Yes, let's do polling question number 2. Okay, which election is more common for a U.S. person owning an interest in a publicly traded mutual fund? Mark-to-market election, QEF election, or who needs any elections? What elections? Hopefully this is a easy question, designed to be that way. Most of the people have voted. Let's just keep this going, make sure everybody gets their CPE credit. And we'll keep it open for another 15 or 20 seconds. And Danielle, let's go ahead and close it out. Of course, the answer is mark-to-market. That's what you would do for a publicly traded fund, which is what our focus today is on foreign mutual funds. So that is the most common. QEF is really going to be more for, you're going to see that for private equity type funds that are not publicly traded, where you have some management is willing to provide that QEF statement, which is effectively providing their information on a US tax basis, and it functions very similar to a partnership. But again, management has to be willing to provide that information. Otherwise, you really can't do either of the two elections, and you're stuck with the excess distribution regime, which is the default, which is the most punitive because you are getting that deferral for US tax purposes, and you have to pay for that deferral on the back end. Now that, Danielle, let's go to the next section. And I think this is Darko or Charlie?
Yeah, it's me.
Okay.
Okay, great. Hopefully everybody can hear me well. I'm going to turn on my camera so that we can keep going. So just as a quick recap, we talked about what the history of the PFIC regime is and what qualifies as a PFIC. And one of the main actors would be a foreign mutual fund or a foreign hedge fund. And then some other entities can fall in that. Then Shelley told us about whether if you have a PFIC, if you do nothing, what happens? You have the punitive, just as Vinay just mentioned, you have the punitive tax and interest regime or the excess distribution regime. If you are eligible to make the QEF election, you get a better result, maybe the best result, because you get ordinary income and qualified capital gains. And then last but not least, if you have a publicly traded mutual fund, then you're the only two options we have is the default regime of excess distribution and or the mark-to-market. So having said that, you have a client who has a PFIC or has an investment in a mutual fund, and you're saying, I may need to file this form for you and report the income, if any. And before you do that, let's figure out who must file and when. So who must file is every US person who is direct or indirect shareholder of PFIC. A direct shareholder, I don't think we need to spend time on, we know what that is. Even if it's 1% or less than 1% of an investment in a PFIC, we have a potential reporting and filing requirement. An indirect shareholder of a PFIC would be a 50% or more shareholder of a CSC that is not a PFIC, and that directly or indirectly owns stock, or a 50% or more shareholder of domestic corporation that owns a Section 1291 fund. Section 1291 fund is a definition of the basic default PFIC regime. It could be a second-tier PFIC, or you have a direct investment in a PFIC, and that PFIC owns another PFIC. That's a second-tier PFIC. So we, as U.S. shareholders with owners, you have reporting requirements. And then last but not least is PFICs held through pass-through entities such as corporations and or partnerships. So those are the indirect structures. There are some exceptions of filing form 80, the PFIC form 8621. And the first exception is for direct owners is if the value of the PFIC stock is 25,000 or less for married filing single, or 50 or less for married filing joint on the last day of the shareholder's tax year, and there are no reportable transactions. Mind you, this is only for the standard excess distribution regime where there is no QF or MTM election. For indirect owners, the same applies if the PFIC stock is $5,000 or less on the last day of the shareholder tax year, and there are no reportable transactions. However, even if the fund value is below these thresholds, and there are excess distribution, if there is a sale of the PFIC stock, well then Form 8621 would be required to report the gain, to report the excess distributions, and the exception does not apply for non-filing. This is only if there is no reportable transactions. Additional exceptions apply if the shareholder is a tax-exempt entity or the PFIC shares are held through some certain foreign pension funds. Again, a little bit outside the scope of the today's presentation. So let's say you have a client that needs to file this, or you need to file this form, and let's just see how this form looks. So the top of Form 8621, information returned by a shareholder of a passive foreign investment company or qualified electing fund. At the top, we'll put the name of the U.S. shareholder, the tax ID, whether it's a Social Security or a federal ID number, address, that's self-explanatory. The tax year for which we're reporting could be a calendar or a fiscal year. And then we need to identify whether the shareholder is an individual, corporation, partnership, S corporation, non-grantor trust, or estate. In the same area where we check off what type of taxpayer we have, there's a box that says check if any accepted specified foreign financial assets are reported on this form. This box, what it does is, if we have a PFIC for which we have a Form 8938 filing requirement, for those that are familiar with the form, we will check this box, and instead of reporting the details of the PFIC on Form 8938, we'll report just the number of Forms 8621s included. Later on, when we're finalizing this part of the presentation, we'll show you how that looks on Form 8938. The bottom part of the top section asks information about the actual PFIC or QEF. So name and address. If the entity has a U.S. tax ID, we'll report it in that box to the far bottom right. Reference ID number, if any is available, and their tax year, whether it's a calendar or a fiscal year. Moving on into the middle section of page 1 of Form 8621, which is part 1. In this section, we describe the classes of shares held by the shareholder, by the U.S. person, any shares that were acquired during the year, if applicable, number of shares held at the end of the year, the value of those shares. And then in part 5, or in item number 5, we report the income, not calculated here, calculating on a few pages back, or 2 sections back, but we report the income that we're picking up in this year, whether it's a Section 1291 under 5A, which is the excess distribution regime, whether it's 1293 QEF fund under 5B, or is it a 1296 mark-to-market fund under item C. So with that, I'm gonna talk about one more slide before I hand it off to Chelsea to tell you to show you the rest of the forms here. But the one other thing that we wanted to highlight here is on page, with the bottom of page 1, we have the elections. So the elections are made on Form 8621 in part 2, and the QEF election is in item A. You check that box that you're electing to choose a QEF, the PFIC to choose a QEF, and that needs to be made in the first year that the U.S. owner owns the PFIC. Same thing with item C, to elect to mark-to-market PFIC stock for publicly traded mutual funds. And supposedly we catch this on a timely manner. We file it in the year when the PFIC was acquired, so that we give our taxpayers the preferential treatment. Once the election is made, there's no need to remake the election, and we just keep on applying the same methodology as we had in year 1. With that, I'm going to hand it over to Chelsea. Or Chelsea, am I talking about late elections, or are you picking up on the late elections and moving forward?
Yes, I'll take it from here.
Wonderful.
And then I'll hand it back to you.
All right.
Thank you, Darko. So, I mean, ideally, want to make the elections in the first year, but it is possible. It cannot. We cannot normally make a late election. However, the QEF or mark-to-market election can be made with a current tax return. And what happens when you do a election, mark-to-market election in the current year, but you've held the stock since before the current year, the gain, the mark-to-market gain in this first year is treated as a Nexus Distribution, which, as I mentioned before, you have to allocate to the holding period and calculate the interest allocable to the previous years, etc. But once you have that first excess distribution regime, you carry on with in the next year with a valid mark-to-market election and continue with the market regime, which is taxed at ordinary rates and not the excess distribution regime. For a QEF election, you can make it in the current year, but if you don't do a purging QEF election, then you will continue to have both regimes applicable, the QEF and the excess distribution regime, which this is not ideal, is really complex. For clients, we normally, if we make a late QEF election in the current year, we would simultaneously make a QEF election, a purging QEF election. So what is a purging QEF election? It's an election that you make to effectively tax your built-in gain in the PFIC stock. And this is to avoid the excess distribution regime going forward with respect to those pre-election years. The purging QEF election is either a deemed sale election or a deemed dividend election. Deemed dividend election is only allowed with respect to PFICs that are also CFCs, and these purging elections are also made in Part 2. I'll go back to the previous slides to show you these elections. If I can, okay, sorry about that. Here we go. So the box D and E would be these elections. These elections would be, if you make it simultaneously with a QEF election, we would have both box A and box either D or E applied in the same year. So that way you, going forward, have a QEF and you've relieved the taxpayer of the excess distribution regime going forward. So continuing on with the form, moving on to Part 3. Part 3 is where the information for the qualified electing fund regime is reported each year. As I mentioned before, you would pick up your pro rata share, the taxpayer's pro rata share of ordinary earnings from the QEF, and these are shown in line 6A, as well as the pro rata share of total net capital gain from the QEF in line 7A. The amounts from net capital gain may then be subject to the long-term capital gains rate. Go from line 8 and 9, these section right here is only applicable if an election is made in Part 2, going back to Part 2, to defer the tax on the QEF inclusion. So this, I don't want to spend too much time on this, but essentially a taxpayer that has made a QEF election with respect to a PFIC might elect on an annual basis to defer the payment of the tax liability attributable to undistributed QEF inclusions. And so this election is made, again, Part 2, box B, and it's made on an annual basis. And if that election is made, then these lines 8 and 9 would be applicable. Moving on to Part 4. Sorry, there's a delay in the slides. Part 4 is for the mark-to-market elections only. Here you report the fair market value of your PFIC stock at the end of the year, as well as the adjusted basis at the end of the year, and the difference if that is positive or it's a gain, then you would recognize an ordinary income in your return. And to the extent that the difference is a loss, so there's a negative number, you will move on to see if you have any unreversed inclusions for purposes of determining if the loss is allowed. Finally, line 13 here, applies if you disposed of the stock. So if the stock was disposed, there are additional rules to determine if the loss that is in excess of the unreversed inclusions is allowed. And part 5 is distributions from and dispositions of stock with respect to a stock of a Section 1291 fund. A 1291 fund, as Darko mentioned previously, is a fund, a PFIC stock in which you've made a QEF election, a qualified electing fund election. There, as we mentioned, this is the excess distribution regime. Sorry, not which you make a QEF election. Sorry, this is the excess distribution regime. So to the extent that you're subject to the default regime and you received either a distribution of your sold the stock of the PFIC, it will fill up this section beginning with the distributions in 15A, and then there is a separate line for the disposition of stock in 15F. This section is also applicable to the extent that you're making purging elections. So if you these are the deemed sale, deemed dividend elections, where the excess distribution regime is also applicable, and to the extent that you make a mark-to-market election in a year following the first year, where you have that also excess distribution regime apply on the gain for that first year of the mark-to-market election.
Hey, Shelly, this is Darko. Can you go back to the slide that you were just a minute ago and talk briefly about the mechanics behind the cells in the box in 15A through 15C and D on the 125% calculation? I think that would be maybe a little bit beneficial for our listeners to hear how that mechanically works. Say you receive a $100 distribution in
Sure.
the calendar year, and then how do you test that against the prior distribution?
Sure. So yeah, this section helps you determine if it's an excess distribution. I think that's going back to earlier on what is an excess distribution. So 15A, you will enter the total distributions from under the excess distribution regime, and then under 15B, you will enter the total distributions in there, divide by 3, which is the 3-year period, and multiply that times 125%. This is all for purposes of determining if a portion of the total distributions from the current year are excess distributions. So this part helps you in doing that math. To the extent that there is no excess distribution in the current year because there were distributions in the previous years, then those distributions are taxed under the normal Internal Revenue Code rules, which means they could be eligible for qualified dividends, or they could be return of basis, or they could be capital gains treatments. So without getting into those details, this will help you determine if it's an excess distribution or not. And then 15F, as I mentioned before, would be with respect to the gain or loss on the actual disposition or deemed disposition of the stock. Is that helpful, Darko? Is there anything else you want to cover?
You. No, that's exactly what I wanted to capture for our audience. And the punitive part is that if there's an excess distribution, let's just say we treat it as an excess distribution, then the part of that distribution is treated as is carried back to the whole entire holding period of the PFIC, which is the punitive aspect, and then the tax and interest calculation on top of that. So, Vinay, you were going to say something.
Yeah, I was just going to add kind of how I look at this, meaning that the whole purpose of an excess distribution is to avoid deferrals. So if I've invested in a foreign mutual fund that invests, say, in debt and is paying a consistent distribution during my entire holding period, I might very well have a PFIC. I probably do have a PFIC, but I may not have any excess distributions. So the whole point of this line 15B, C and D is really to say, have I had a deferral? Have I invested in an equity fund that's not paid out any dividends, and then all of a sudden, bang, it pays out a big dividend? And now I've got an excess distribution. So it's important to understand what kind of fund it is you're dealing with, because that right off the bat could tell you whether you're going to have more complex or less complex calculations. So, Shelley, you can continue. Sorry for the interruption.
No, that's really great insight there, Vinay. Thank you for that. I'll move on, and we have an example coming up next. I think Darko will go over and show in more detail on how to complete that specific part about the excess distribution and the tax and interest. So I'll cover here quickly 8938. This is a snip of the heading section in part 4. As Darko mentioned before, to the extent you're filing the 8621 and you mark that box in the first page of the 8621 saying that you're reporting a specified foreign financial asset through reporting the 8621, then you would mark in part 4 here the number of 8621s filed, and you wouldn't have to fill out the details of the PFIC stock and the value that would normally go in the 8938 form. With that, I'll pass it back to Darko to do this example.
Thank you, Shelley. All right, so we've been talking a lot about this excess distribution regime, and we wanted to kind of walk everybody through I'm going to call it simple, nothing is simple about this, but a simple example with within one PFIC fund that has a number of sales within 1 year with different holding periods. So the way the PFIC regime works, you look at every separate batch of stocks that are held in that fund, meaning if a person invests in multiple dates and buys the same mutual fund stock, and it could be from reinvestments, obviously, that means we have to account or track those separate lots, all those lots separately. So this client has, I believe, 7 lots or 6 lots, and he or she sold all of them in calendar year 2020. You can see the purchase date 2018, 19, and 20, and then the sale date is January and March of 2020. We calculate the gain on each lot separately, gain or loss, I should say. And for reporting purposes, the instructions say that we need to report each separate lot, each separate holding period on a separate part 5 of the PFIC of the Form 8621. However, sometimes that becomes impractical if there's multiple lots, so sometimes they get combined. For all intensive purposes here, we've combined them, but we don't. We recognize that is not the prescribed method by the IRS. So as you can see here, the first 2 lots have a gain of 177 and 91 in the second to last column, and then the rest of the 5 lots have a loss, each of them, of 25, 94, 346, 264, and 280. The way it works for PFIC, as Shelley mentioned earlier, all the gains in the excess distribution get taxed under the excess distribution regime. However, all the losses go nowhere. We don't get to deduct them. So let's see how that looks in terms of reporting. First, we'll look at the calculation of the holding periods by year, the tax, the increase in tax, and the interest calculation. So let's start with the $177 gain. The $177 gain has a holding period of 418 days, which we split between 3 years. In the second box there, we see tax year 18, 19, and 20. We allocate based on days, so 33 days in 18, 365 in 19, and 20 days in 2020. And then we allocate that $177 to each year. That is $13.97, $154.56, and $8.47. The interesting part here is that 2020 year does not go through the tax and interest regime. Rather, it goes as ordinary income on the other income line. Back in the day, it was line 21. Then we moved to Schedule 1. I believe it's still on Schedule 1 today, but that's where that 847 would be reported, and we would add the same from the other disposition of $91, which relates to $4.69. So total of $13 would go as other income. The prior years of allocated gain, we would calculate the tax at the highest marginal rate for that year. I believe 18 and 19, the tax was the highest marginal rate was 37%. So we take 1397 times 37%, you get $5.17. If somebody's checking my math, I hope you get to the 37% rate. And then last but not least, on each of those years, we look back to the original due date, which is April 15th of 2019 and 2020, and calculate the IRS interest for the underpayment interest. So we get 47 cents and $1.99 for the first two funds. We add all that up, and then we get the reporting. We do the same thing for Fund 91. So this schedule that you're seeing is coming from a nifty software that is available to practitioners and taxpayers for hire. Although it puts the information together in a nice, concise way, and may save you a ton of time and a ton of headache trying to calculate this in a spreadsheet, in an Excel spreadsheet, as we used to do back in the day. So then what we do is we take the information from these fields, and you'll see at the top here says line 16B, 16C, D, 16E, and 16F. We accumulate it and report it on Form 8621. Again, for purposes of this presentation, we've grouped everything for practical purposes, but we will report it separately. So before I go into the actual reporting on Part 5, I'm going to go back for a second and look at the reporting on page 1. So report common shares, date acquired, number of shares held at the end of the year is 0. Value of the shares is between 0 and 50,000. Then we also report the PFIC gain under Section 1291. So then we go to Part 5. We skip Part 2, 3, and 4 because that's the mark-to-market and QEF regime, and we report the gain on line 15F of 268. On line 16B, we report the current year gain. That's the $13 we spoke earlier of that is getting picked up as ordinary income. And then we skip the entirety of the gains from the prior period. We just report the additional tax of $94 and additional interest of $4. And that's the gain portion and the tax. The tax and interest gets shipped over to the 1040 page 2, where we calculate the tax, and then the $13 gets picked up as other income. And last but not least, I believe I misspoke earlier, the $1,009 loss, I believe it gets carried over as a capital loss, but we'll confirm that and get back to the group if that's unclear at this point. So that's the 1,009 gets separated. It gets reported separate because it becomes a capital loss, and we can't offset the PFIC gains with the losses. And with that, okay, so that's the calculation reporting. We wanted to kind of have you visualize the tax and interest calculation from this schedule and see how that looks on the forms when reporting. And then we're going to talk about a couple of proposed regulation aspects that we wanted to cover. So one of the aspects in the proposed regulations is that currently, under current law, if a partnership owns a PFIC, the partnership is allowed to make a QEF election and report the Form 8621, and that absolves all of the partners from reporting on the PFIC or filing Form 8621 or making any elections. So the partnership, the first U.S. taxpayer gets that choice. Under the proposed regulations, that goes away, and the IRS is trying to get the ultimate U.S. shareholders to be the reporter. We don't know if that's going to pass muster, but that's what we think. That's what they're trying to get to.
Sure. Csc and PFIC overlap rules applies with respect to a particular shareholder. So the there could be a foreign corporation that is both a CSC and a PFIC. The CSC is based on how many people, how many U.S. persons own, what percentage they own in the foreign corporation. So you look at a particular shareholder, a U.S. person that owns stock in an entity that is both a CFC and a PFIC, and with respect to that person, you apply the overlap rule, right? So if the person is subject to the CFC regime, then it's not going to be subject to the PFIC regime, and that rule has been around for a long time. I think the proposed regs would just confirm that in a partnership situation where the partnership is the owner of the entity that's both a CFC and a PFIC, you would not consider the partnership to be a U.S. shareholder of the CFC for purposes of ruling out that's not a PFIC with respect to the indirect unit owner. So, and that would just be a confirmation how a rule works around partnerships in order to kind of wrap all the recent TCJA changes that had changed the taxation with respect to the CFC regimes. And obviously we don't want to go into the CFC regime because it's not part of this training, but that's something we just wanted to mention so that people can be mindful of that rule. I think this situation would only be if you have U.S. persons owning an entity less than 10% of a partnership that owns a CFC, potentially. So with that, we can move on to the polling question, Vinay. Thank you.
All right, so let's start polling our third polling question. A U.S. person owns PFIC stock with a value of $20,000. In the current year, the PFIC stock is sold, so no PFIC regime applies or Form 8621 is required. True or false? That about 70% have voted. Let's keep it open for another 10, 15 seconds. Okay, we're Danielle. Why don't we close the poll? And the answer is false, because regardless of the value of the PFIC, you're going to file a Form 8621 in the year of the sale. Okay, so why don't we continue, Danielle?
Danielle, do you want to hand it off to Parag? I believe he. Oh,
okay.
actually,
No,
this is you.
Okay.
Yeah.
Okay. This will be very brief. So we still spend a lot of time talking about the federal treatment. We picked New York and New Jersey just because I know a big part of our audience is based in New York and New Jersey. I'm just trying to advance the slide here. There we go. So New Jersey is actually kind of unusual, because New Jersey, for individuals, has the Gross Income Tax Act, which is really kind of disjointed from the federal tax code. And but what New Jersey does do is they follow federal accounting method principles. And there's really very little authoritative on how New Jersey deals with PFICs. There is an administrative article from the State Tax News going back to the year 2000, which is the most recent thing I found, that basically says New Jersey is going to follow the federal method of reporting, whether it be QEF, mark-to-market, or excess distribution. Now, when it comes to excess distribution, some of the nuances like paying tax at the highest rate and the interest charge don't really apply. We didn't talk about it, but there are elections to defer paying tax when you have a QEF. Those don't apply. So for the most part, New Jersey will follow the federal treatment, but to me, that's always kind of fragile in how we get there. New York, let me advance the slide. Danielle, can you do that for me? Okay. Oh, there we go. That's New Jersey state tax news winter 2000. Okay. So New York is a rolling conformity state, which means New York generally adopts the provisions of the Internal Revenue Code. So I think at the end of the day, as a practical matter, you get to the same place as New Jersey, but I think you have just a little bit more clarity on New York. Now, we weren't prepared to talk about it, but I think the key thing is any state you're dealing with, you need to find out generally, do they follow the federal rules or they don't? So California is a notable state that does not follow the federal PFIC rules. Specifically, they don't follow QF or mark to market. So if you get into California, and I'm not prepared to go into the details, you have to undo a lot of the things you do federally and keep a separate set of California calculations. So anytime you're dealing with a multi-state taxpayer, you need to be sure to see how is your state going to treat the PFIC. So with that, I think we're at the end of the state tax treatment, and we go to Parag, who's going to tell us what to do if something didn't go as planned.
Okay, good afternoon, everyone. Nice to kind of see everyone in a little, weird way. And Vinay, please interrupt me if the video or the bandwidth, if we have any problems. So I'm going to quickly run through non-compliant solutions. First of all, what happens if you don't file a PFIC? The answer is, unlike pretty much all other international information forms, such as 5471s, 8938s, FBARs, there are very high penalties. There is no penalty for an 8621. So that's great news, kind of, because if you don't file, there's kind of you're kicking the problem forward into future years, tax and the large interest charge. Often the interest charge is higher than the tax if you wait long enough and you're delinquent long enough. So it's generally to your advantage to file the Form 8621 and to make the election, whether it's a mark-to-market election on the current income of the PFIC, to avoid these taxes and interest charges in the future. So you should, as soon as you discover a PFIC, you want to address it. You don't want to deal with the 86 problem later on, because it's going to make it even more painful. It's like a headache. You want a small headache now or a big headache later. However, you have to watch out for other penalties. While there's no 8621 penalty, most people that have a PFIC fail to report it somewhere else. For example, 8938 is often applicable, and that has a penalty of $10,000 non-willful per incidence. And also, you have other penalties as well. The other penalty, and I'm going to go quickly, there's a lot of slides here, I'm not going to discuss most of them. There is no 80, but there's also an FBAR penalty often. If you don't have an 8621 that's filed penalty, then you're going to have probably an FBAR penalty. And last but not least, most people are familiar with the accuracy-related penalty. In the domestic world, it's about 20%. In the international world, if it's related to a foreign financial asset, that escalates to 40% of the tax underpayment. So there kind of is a backdoor type of penalty for these 8621s. And last but not least, there's a statute of limitations. I'm sorry that I'm kind of slipping through these slides quickly. What that means is that if you don't file the 8621, the entire return basically remains open indefinitely. Some commentators think that it's only related to the portion of the PFIC. I believe it's the whole return. This means that you're open. It's not the 3 years, but it's the 3 years after you file. So basically it's open forever until you file the form. So it's important that you tell your client that, hey, there's lots of benefits to filing the 8621. In addition to attacking a problem early, you otherwise have the exposure and risk of having a statute of limitations open for a long time. Now, one question that many clients ask is, so what? How's the IRS going to find out? For many years, the IRS has been sleeping. Recently, I've seen clients, for example, this is a tax notice that was received for a 2019 year. So as all of us know, everyone thinks the IRS is sleeping. They are mostly sleeping. However, they create lots of mail, as we all know. And this is one instance of a client getting mail saying that you have not properly reported a foreign financial asset. And even further, this black spot basically says the name of the bank and the account number where the IRS has discovered that the foreign financial asset exists at. So the IRS, for people who think the IRS has been sleeping and not really, comparing databases, they send these 3-page letters. They explain to you what you need to do. You're not hunted entirely. You're not entirely under audit. It's just a letter you don't want to get because you've basically have been discovered. And most of the time, here's another variety of the same letter. There's 2 different varieties we have in the forms, but basically in the presentation. But these are the letters where the IRS is basically discovering, and we received information that you have a foreign account. So this is nothing that anybody ever wants. And by the way, they all come from Texas. These IRS letters, which by the way is the same office that is in charge of the very popular streamlined program. Now this, I wanted to spend just maybe 10 minutes on this, or 5 or 10 minutes on this program. It's a very popular program, and this is the program that cleans up this type of a mess. So again, 8621s are part of the mess. It's an area of non-compliance. You can only file the 8621 and make the election for the current year, not going backwards. But you were able to file all the ancillary forms such as the 8938s and FBARs and immunize your clients against future discovery and penalties and so forth by going through this program. This program is a very popular program. It's been in existence since 2014, and it's helped probably tens of thousands of taxpayers over the years since it's been in existence. The IRS says they can close the program at any time. I think they're not going to, simply because the IRS is making a lot of money, and it's basically a program that doesn't require a lot of manpower on their part, and it allows the IRS to bring a lot of people into compliance. This is a pretty well established program. I just took a screenshot of the IRS website. You can read all about it on the IRS website. There's lots there, even including FAQs on how to what applies and so forth. The general eligibility is that there's 2 programs. There's a streamlined foreign, which is SFOP, and there's a streamlined domestic program. Domestic means that you're not a foreign person, and that means that you live outside the United States for some period of time. Domestic applies to most of our clients that reside here in the United States. And as I said, it's a very popular program. This is the form that everyone needs to file. It's a quick screen grab of the form, the IRS form 14654. Basically, you explain what tax you owe for the past 3 years. You pay 5% penalty on the highest balance over the prior 6-year period. And the IRS wants to know a very long question about why you are non-willful and satisfy the requirements. So this is a quick screen grab of the sentence, a very long sentence that the IRS asks you to fill out, but please explain how and why you failed to report all these various forms and the whole story, whether it's favorable, unfavorable, and basically the IRS assesses it. In my experience, the IRS is fairly liberal in terms of rather say forgiving the way they let people into the program. I have probably filed about 400 applicants into this program and have had very, pretty successful. I don't think the IRS is interested in, hanging anybody in this program unless you're lying or you are putting in a client that has willful facts. Then for most part, I think that this is a fantastic way to clean up a mess. The IRS wants the whole story, whether it's favorable or unfavorable, to explain what's willful. Willful is not basically what's not willful, meaning that non-willful means that you are explaining the whole story, whether it's non-willful means a good faith misunderstanding of the law, which is what applies for most clients. I go through what's non-willful examples here. The difference between the streamlined and the foreign. Basically, if you're foreign, you have to be outside the United States 11 months over the past 3 tax years. If you are lucky enough to be a foreigner, then it's a zero penalty program. But it's as I said, a program that you have to file quite a bit of information. The accountant is expected to kind of cleanly, correctly prepare the returns, reporting the 8938s, the FBARs, the 8621s. Again, you'd be able to make a 8621 under the mark-to-market election with the current year, not the backward years, not going backwards. You file the delinquent amended FBARs for each of the most recent 6 years as apply, and you attach the certification that 14654 or 14655, whatever applies. But in the end, it goes to Austin, Texas, and as I said, the IRS has been accepting most of them. I wanted to explain one important program, and if I just explain a couple of quick fact patterns I've had. Sometimes you have someone with an 8621 where there is no tax due. How is that possible? Sometimes, for example, maybe through a U.S. tax treaty, for example, with the UK, if you have a mutual fund that's held in a UK retirement account, UK retirement accounts, some of them are exempt and are treated as reciprocity, and therefore you don't have to file an 8621, and there's no tax due. If you are lucky enough to have a client where there is no tax due, then you would not go through the streamlined program, you would go through this other program. This other program is called the International Delinquent International Information Return Submission Procedure Program, very long name. And again, this is available on the IRS website. But it is a way to cure failure to file 5471s, 3520s, 8938s, 8621s, all of these various things you can file as long as there's no tax due. You'll need to make the affirmative statement that all income has been reported and there's no tax due. And sometimes you end up in these situations where there is no tax due. I would say the majority of clients, there is tax due, and you'd fall into the streamline as opposed to this program. There's another program that exists, and that is when people just need to file FBARs, meaning that there is no 8938, there's no 8621, there's no 5471, you just have a delinquent FBAR. If you have no tax due and everything has been reported, which is a big maybe, because often, as I said, there is tax due in most situations, or income needs to be reported. But if you happen to have a client that does not have any tax due, an example of that could be, an interest-free account, or for some reason there is, it's an exempt asset under U.S. tax laws, and therefore there's no reporting required. In that situation, you have this delinquent FBAR submission procedure. Again, it is a program that exists under the IRS. You can look at the website, but you basically need to file. You can go file up to 6 years backwards, zero penalty. Again, I'm sorry, the first program I just mentioned to you, the Delinquent International Information Return Submission Procedure Program, that is also a zero penalty program. So people should look at these two programs first because they're zero penalty and far simpler in terms of application and acceptance, in my opinion, in my experience with the IRS. If you can't go through one of these doors of the IRS where there is zero penalty, then you'd go to the streamlined program. But this program, this website at the IRS explains what is needed. You shouldn't be under exam, not already contacted by the IRS, and there's you don't need to go through the other programs to report the income, in which case then you consider this program. I think we have our last polling question.
Yes, thank you, Parag. Danielle, can we go to the next polling question? Okay. The penalty for not filing Form 8621 is generally $10,000, 25% of the PFIC stock, 0 or 25,000. So if everybody could respond to this last polling question, we will then go to our concluding comments and answer a handful of questions that we have. And we're at 90% of the vote in. Let's wait for another 10 seconds or so. All right, Danielle, why don't we go ahead and close the poll and show the answer? And as Parag mentioned, the answer is 0. But again, that doesn't relieve you of the obligation to file a FBAR, which has some pretty serious penalties, as well as potentially an 8938 that can have its own penalties. So keep that in mind. So now for the concluding comments, I think Darko, you were going to take care of that?
Yeah, of course. Danielle, did you want to give me control of the slide deck, if you will, please? There we go. So we've put a few bullet points, or more than a few, I guess, for you guys here, in order to kind of put away a few thoughts on takeaways and best practices. And, you know, I'm going to go through every single one of them, but we'll just mention a few so we have time to address some questions from the audience today. So one of the things that the second bullet that we've talked about already is consider the QEF or NTM elections in the first year we have a PFIC, or in subsequent years if it economically makes sense to consider a purging election. Sometimes a check the box election is a good planning strategy. When you have a PFIC, you don't want to be, your client doesn't want to be in the QEF regime, they don't want to be in the mark-to-market regime, or the exit distribution regime. And if it's possible to make a check the box election, then that may be a planning strategy as well, where the foreign entities act as a partnership without the QEF regime in place. At times, there could be planning strategies for availability of foreign taxes paid by the PFIC or on behalf of the PFIC when distributions are made, so we can plan elections around that. The other thing is that, you know, we would advise that everybody reviews the foreign investments on an annual basis, and the potential need for PFIC testing is clear. Discuss the investments with your clients in terms of mutual funds and foreign private equity investments to see if there's any PFIC reporting needed, and potentially do a cost-benefit analysis to see whether there's an election to be made, a purging election, a QEF election, a check-the-box election, whatever it may be. There's some modeling to be done there if something pops up. For those that have clients that are moving into the U.S. and becoming U.S. residents, of course, these are discussions that you want to have in terms of disposition of foreign mutual funds or PFICs pre-migration. If the economics work out, of course, modeling needs to be done in order to look at that. And then I was going to ask for Parag to come back online and talk a little bit about the second to last bullet in terms of planning strategies.
Well, just recently, the Biden administration proposed to expand access to retroactive QEF elections on amended returns without obtaining a PLR. Now, PLR is an exhaustive, very expensive proposal to do. I'm not sure if this is definitive. I think it's just a proposal. I don't think I've seen this relief before. And then remember, let's just back up. This is probably one of the most complex seminars I think that we've ever presented on any topic. Really, PFICs are very complex. QEF elections are, in my experience, quite rare, just because you need the provider of the PFIC to provide these type of annual financial statements. So if you have a foreign mutual fund, most 99% of the time, that's not an option. So don't even think about that. If you happen to have a client that has a private equity fund investment, and I've seen a few of them that have that, where they provide fairly comprehensive annual financial statements, then this is for you. And if you can do that, that's great. But I don't think that this is available yet. I think it's still pending. Darko or Vinay, if you have any comment that we could see. But this is fairly big news if it applies to your client. Otherwise, as I said, a majority of people, it won't affect them.
Right, I agree, Parag. It's just a proposal at this point, and you know, it'd be nice if it happens. It gives us another planning idea, but
now
at this point.
Much better relief that the IRS could do is, and which would be far more charitable and generous of them to do, is that allow us to have a delinquent mark-to-market election. That would be a game changer. That would be big news if they would allow that, because that would be able to go backwards and really stop the bleeding on a backward basis. Now, remember, in the Streamline program, you only go backwards 3 years, so it stops the bleeding, you know, up to 2-3 years ago. So it doesn't help someone that has a mutual fund a decade or longer, because, you know, again, if you have a client that comes to you that has a foreign mutual fund that is deemed to be a PFIC, as most foreign mutual funds are, then you have a big problem if it's been there for a long time. There's a lot of work, there's a lot of preparation, there's a lot of tax that if it's a big amount. So you're going to look for the first thing to do is look for possible exemptions. We talked about exemptions today. For example, maybe if it's in a retirement plan or some other type of exempt entity. Another exemption which kind of is under the radar is foreign life insurance, which, by the way, it has to be a life insurance, deemed life insurance under US tax laws, which is kind of rare and hard to do. But there is a regulation that states that if it's a foreign life insurance product with PFICs inside of it, then there's a possibility of a non-filing of an 8621 in that situation. So you have a couple of these possible exemptions. Of course, you have that $25,000, $50,000 exemption as well. But if you have a big client with a lot of, you know, over $50,000 in mutual funds and with a held for a long time, this is a problem and a headache. So just be aware of that.
Excellent. Thank you, Parag. We're at 4:30. If you have to drop off, feel free to drop off, but we do have 3 questions. I'd like to try to get to them quickly. One question is to clarify, if there's no distribution and total value is under 25,000 or 50,000 based on filing status, is it true that there's no requirement to file Form 8621? I think that's correct, but as we said, you still have obligations for FBAR and potentially 8938, and it doesn't really change the underlying method of taxation. Parag, Chelly, Darko, anything to add to that response?
No, that's absolutely true. Remember that those exemption levels are great and they apply, but if you have an excess distribution or a sale in that year, then doesn't apply. Okay, so just be aware of that.
Okay. Next question, if you miss a mark-to-market election in year 1, are you precluded from ever using it? Question mark.
No.
Anybody want to take that one?
Yes, I can take that one. Sorry, I didn't realize we were turning our cameras on. So
we don't have to. It's peer pressure.
Yes, if you can make a mark-to-market election in a year other than first year, however, the gain for that first year will be treated as an excess distribution reported in Part 5 entirely. So after that first year, you can continue to do the normal mark-to-market election calculation, which is ordinary income, no punitive tax regime. But that first year would be an excess distribution. Hopefully that clarifies. One thing that I wanted to mention about the mark-to-market regime is for non-resident aliens that become U.S. taxpayers, the election, if it's made on the first year that they become a U.S. person, is really beneficial because they can step up their basis in the stock to the fair market value as of the day that the person became a U.S. person. So in that situation, you want to make sure that you get it right in the first year.
Even better is get rid of the mutual fund before you become a U.S. citizen. So just disinfect yourself, immunize yourself, and just divest yourself of everything that could attract these type of problems before you come here.
Right. Excellent. The last question was early on when Darko, I think, was speaking about, or maybe Chelly was speaking about the definition of a PFIC. How do you define active trade or business for rental purposes? So I think that's the age-old question. I'm not going to hazard a guess.
It's a good question. I believe it goes back to what is a trade or business, and if that rental real estate can be qualified as an active trade or business under, I forget. I'm not gonna say the code because I don't remember from the top of my head, but for a rental real estate, I believe to be treated as an active trade or business, it's gotta have it can't just be receiving rent. It's gotta have employees, maintenance, gotta be running a business. Active business, maybe have multiple rentals, maybe a big commercial property or multiple commercial properties. So it requires a little bit more activity.
Yes.
Right. It's not the Section 469 passive definition. Somebody says I'm a real estate professional and you've got your answer. So it's a more subjective criteria, I believe.
Yeah. So the rules for that, just to clarify, are under sub-RF rules. So under section 951A, the regulation, the same exception that applies from a sub-RF perspective is applied in this concept. So you look under the 951A rules to see what is an active trade or business, and it does require employees of the actual entity. It cannot be employees of other entities, generally speaking. So that's where one would start to look for that requirement.
All right, thank you, Kelly. And I think that concludes our webinar for today. So on behalf of Patel Law Offices and Wilkin Dutton Plan, we thank you for spending some time with us about the fun and exciting topic of PFICs. You should be getting your CPE certificate by email. If you don't get it, feel free to contact any one of the four of us and we'll help you follow up. Thank you and have a good rest of your day.
Thank you.
Thank you.
Bye, buddy.